So this is Mr. X and he has a business, Mr. X, and he has a company. The company's name is ABC Limited. So Mr. X has to prepare the financial reports at the end of the year to know the profits from the business. Okay, and he has to prepare the tax returns to know the taxable profits. So I mean to say here, this is accounting profit, this is taxable profit. So when financial reports are prepared, a business knows about the accounting profits. Okay, so what profits they have made out of the entire activity what they are performing. And when a business prepares tax returns, they know what is the taxable profit and how much taxes have to be paid based upon these taxable profits. So now I have to say you the taxes are always paid on taxable profits. Okay, taxes are paid on taxable profits which the business derives from or by preparation of tax returns, that is income tax returns. Okay, now to prepare the financial reports, the company has to follow US GAAP. To prepare the tax returns, the company has to follow tax rules. Okay, so here accrual concept is followed. That means you know very well about accrual concept. Outstandings and prepaids all we can show here. And here cash basis is the basis for preparing the tax returns. That means here if there are outstandings or prepaids, they can be shown in the books. Here the in case of cash basis, there is no chance of outstanding, no chance of showing outstandings or prepaids. The transactions are only recorded when the business receives cash on those transactions. I would give you a very good example of this. Credit sales. Credit sale. Credit sale is what is considered a sale as per the accrual concept. That means accrual concept does not differentiate between cash sales and credit sales when these are recorded in the income statement. Okay, so what they do is, in case of credit sales, they write sales in the income statements as revenue 1 lakh, and they know that on these 1 lakh they are supposed to receive money from the customers, so they show receivables in the balance sheet. But in the case of when you prepare tax returns, only you record the revenue when you receive it. Okay, not when it is a receivable. So these two things you should understand. And one more difference I would like to explain. If suppose income received in advance, so accounting profits, tax profits, or tax returns, financial reports, tax returns. Okay, so in this case what happens, you show income received in advance as a liability. Okay, because you would be earning the income in the future. For example, if I take 1 year's advance rent from my tenant, I am not earning that income. It's a liability for me. After 1 month, I recognize 1 month's income. as a rental income, and still 12 months rental income I'm supposed to receive. So second month has passed on, so I just recognize second month's income as rental income, and still 8 months, still 10 months rent I cannot recognize. It's a liability for me. Okay, but in case of tax returns, they recognize the entire income what they have received in advance as income. Okay, so they don't care about whether the tenant is going to vacate the house in between the year or not. That is not the premise, or that is not the thought process behind the cash basis or preparation of tax returns. So when I speak about cash basis, it's very simple and clear. They record all the transactions when they physically receive the cash. Here it has nothing to do with receipt or payment. Here everything we record, whether it's outstanding or prepaid, based upon the earning or based upon the based upon incurring the expenditure. So here the expenditures are recorded when they are incurred rather than paid, and incomes are recorded when they are earned rather than received. So receipt and payment is not a matter of concern here. Here earning and incurring, earning of income and incurring expenditure is what immediately they recognize the things in the books. Okay, here only when they receive they recognize the things. Fine. Now I'll speak about some more points here. So here I'm speaking about two things. See, this is financial report. This is tax return. See, this financial report and tax returns, of course, we have seen what is the difference between these two and what kind of concepts they follow to prepare these two. Okay. Here the depreciation methods can differ. Here the depreciation methods can differ. Here straight line method can be used. Here MACRS method or diminishing balance method can be used. Okay. Here the transaction can be recorded earlier, and here the transactions can be recorded later. If I speak about installment sales, as I said you, here the entire amount will be recognized. Why? Because when there's, suppose there is a bike and the business has sold a bike, that bike's money they have received, they haven't received yet, because it is a installment sale. They have only got the down payment, but they recognize the entire amount as sales or revenue because they can do it as per the accrual concept. Here the, in case of tax returns, they cannot recognize installment sales as revenue. They would recognize the revenue only when they receive the installments. Okay, so these two things you should understand. And since there are like timing differences here, am I right? What is this? Timing differences. So what is this timing differences? Very simple. Here the revenue has been recognized in case of installment sales at the beginning. That means they recognize the revenue when they sold the bike. They did not care about receiving the cash. Okay, because receipt is not the one based upon which the transactions are recorded. The transactions are only recorded when they are incurred. That means when the bike has been sold, they have earned the revenue for that. They did not receive it, I understand, but receipt is what we don't consider. We consider only the earning aspect and we record it. Here it is only recorded when the cash is received. So cash would be received at the end of the year as first installment. So they'll be recording at the end of the year. So because of timing differences, deferred tax asset and deferred tax liabilities are created. Now what is this deferred tax asset and deferred tax liability? So timing differences and treatment of like different methodologies or different methods of depreciation can cause the can cause the can cause the formation, or it can create deferred tax asset and deferred tax liability. Okay, now what is this deferred tax asset and deferred tax liability? You will understand. Suppose this is 1 lakh, the profit before depreciation. Okay, this is accounting profits. This is 1 lakh here, the profit before depreciation in case of tax returns. Here we are using straight line method. Here we are using diminishing. Let's say we are using double declining method. For example, here the depreciation has been deducted, that is 10,000 and the profits are 90. And here the depreciation has been deducted as 20,000 and the profits are 80. Okay. As I said, you always pay tax based upon tax returns, and you always create or make a provision for income tax based upon accounting profits. I'll again repeat, you always make provisions to pay income tax based upon accounting profits. So now I will give some terminology to it. Here this creates a tax liability, okay, or tax payable. That means you will be always paying tax based upon your tax returns. Here it creates income tax expense or provision for tax. That means this is a estimate what you make, and this is in reality what you pay the tax on. Okay, so this amount is the one based upon which you pay taxes. This amount is the one based upon which you prepare your tax estimates, or what you are supposed to pay. Okay, so let's say the tax rate is 30%. So 80,000 into 30% is what? It's like 24,000, and 90,000 into 30% is what? It is 27,000. Now your income tax expense or your provision, what you have like made is 27,000, and you paid taxes of 24,000. So still you are supposed to pay how much? 3,000. So this is your deferred tax liability. Okay, so income tax expense is equal to tax payable plus deferred tax liability. Okay, so this is the formula, and here it is very simple. Now, if your accounting profits are more than your taxable profits, okay, so your accounting profit was more and your taxable